Hello, ladies and gentlemen. My name is Greg MIchalowski. Today's date is February 5th, 2015, and we're going to do another Forex Live Hangout. Me being Adam Button, he's the guy on the top, and myself is Greg MIchalowski. We're going to take a look at the employment preview. There we go. There's my head screen. I didn't mean to have have the picture on you, Adam, but I'm learning. Anyway, we're going to talk about the employment report. Back to you, Adam. We have a non-farm payroll and all the other employment statistics come out. What are you going to be looking for? What are the keys for you? And then we'll talk a little bit about trading it.
Great. Yeah. So I just put up a preview on the site. It runs down all the important numbers ahead of non-farm payroll. So, I like to look at things, the ADP number, and see how that might have adjusted payroll. So we look at the estimate after ADP and the ISM non-manufacturing employment index. Both those were a touch on the soft side. Mm-hmm. So we've seen estimates come down a little bit. The consensus is 225K. The market's probably around 215, 218-ish range. That's not really a notable difference. But there, on the downside, there's a few factors as well. Challenger job cuts. There were a lot of layoffs in January that showed up in those numbers. But if you see some of the other skews, consumer confidence, jobs numbers, those were very strong. So it's a very much a mixed picture, and it's tough from the data ahead of time to get any kind of skew. The one spot to always watch is going to be participation. If that starts to rise, there might be an unexpected jump in unemployment.
How about earnings? What are you thinking about earnings? Is that going to be another important thing to look forward to in this report? Last month we had minus 0.2% for the earnings, big surprise to the downside, and I think the prior month was revised lower as well. So, what's your take on the earnings?
Yeah, the Fed, it's the number one question in markets right now, whether jobs growth is going to be passed on in terms of wages. So we got today unit labor costs in the productivity report were out, and it was very strong for fourth quarter, but the third quarter was revised way down. If you combine them, the second half of the year wage growth was 0.2%. That's real wage growth. That's very, very weak. And again, last month you had a weak number. You could get a bounce, and I think the Fed is likely to take a bounce as a sign of the trend. I think the Fed right now is wearing some rose-colored glasses in terms of wage growth. So if you see a strong number, the Fed's going to believe the strong number and cast aside the weak number. And they'll be talking more about rate hikes even more in the coming weeks if that's strong. And the downside, though, there are risks there as well. And I think it's a very important number. There's some research out today from Deutsche Bank talking about the reaction in the market to non-farm payrolls, and they said it comes in four parts. The first number is the actual jobs gained lost, followed by revisions, then the unemployment rate, and they say that over time the most lasting and largest market mover, and I'm not sure how they calculated this, was wage growth. So if you're a trader, on that first number, you're not going to be able to compete with the algos. It'll happen almost instantly. The revisions, maybe if you're getting quick. Same with the unemployment rate, especially if it's a skew with participation, so watch that. But the way to trade it might be on wage growth gained or lost, especially if it goes against the headline number and the knee-jerk reaction.
Right. I think so too. You mentioned the revisions as well, and I was looking back at the 2-month revisions that we've had over the last 4 or 5 months, and the last 4 months have seen revisions to the positive side. And you have to go back actually to about September where we had a negative revision. They combine them now. They have this 2-month revision. So the market tends to look at that as well. But the wages and inflation, is getting a lot of talk out there about how can the Fed think about tightening conditions when things like wages and inflation are so low.
Yeah, I mean, like I said, the Fed is in a real tough spot. But, you look around, and we saw it yesterday, not so much today. The U.S. dollar, it's still the place to be. And it's come off today, and that's not entirely unusual because it's a risk event and because the dollar trade's very crowded, maybe feels a little bit skittish after getting blown out on Wednesday. What is your thinking in terms of where the dollar is and how to trade it around non-farm payrolls?
That's a good question. My opinion is that if you there are two windows of opportunity. One between the time leading up to the report, but once you get to the report time, it's kind of a it's a coin flip for that. And we're not in the business of gambling, are we, folks? We're more in the business of trading and putting the odds of success in your favor. So I don't necessarily, or I don't like to recommend that traders take positions or large positions through the number. And we are seeing the dollar, like you say, get weaker here today. And that may be, an indication that the market might be thinking in terms of some sort of weaker number tomorrow. Who knows? It can come out really anything. There's 300 million people here in the United States. It's hard to sit there and you can be plus or minus 50 and people get all excited about the whole thing. But what you have to do, or the way that I look at trading it and suggest people trade it as well, is make sure that you understand where the key levels are for the currency pair, and then utilize those levels as risk-defining levels after the release, after you know what the revisions are, after you know what the wages are, and then go from there. How do you look at it?
I think that's a good way to play it. I mean, find a trend that you like, find a trade that you like, and non-farm payrolls probably isn't going to change the story, although it's been a little while since we've had a big surprise. But if you have a trade, we've been looking at cable loans. Me and Ryan have been talking about it for a long time. We really we liked it around 150 and got a little bit shaken out on the dip there a few days ago. So maybe if we can get a dip in that again, that's something I'd look to buy. And at some level, like you say, well-defined level that it was there before, and it gives you an opportunity to get into a trade that you may have missed or you may like, if it comes and works your way. Because it's difficult for me to see at this point in the cycle the non-farm payrolls report as a game changer, even if it's very weak. The trend has been strong, and if it's strong, then the trend is continuing to be strong, and really probably isn't going to change the trend in the U.S. dollar. So. That is where I see a lot of the opportunity at the moment, and so then it becomes all about the levels. What are some that you're watching closely?
All right, well, let's take a look at that pound versus U.S. dollar. I have it here on the hourly chart, and this 50% retracement level. This is of this move down, going all the way back to looks like the end of December. There, we're taking a look at the hourly chart, and we moved above that level in trading here today, corrected down to it. And in this last move to the upside, I've seen the price move higher. So this is definitely a level that if you want to sit there and buy a dip in the pound versus U.S. dollar, this would be the level that you would want to focus on, is this 50% retracement level. That would be a dip buying level. Another key for me comes off of the daily chart. So traders who may be long from below, and if you want to risk some of your profit, I don't suggest maybe all of it, but take some profit, but risk some of your profit on a further continuation to the upside, or look for a breakout of the pound versus U.S. dollar off of some surprisingly weak data. Then this move this level right here, which is the 50% of a longer-term move down at this point. The other one was off of this high right here. But this 50% retracement level on this trend line connecting recent highs, which is also parallel to this bottom line, that's going to be a key level right there for me on the daily chart. So if we're able to continue the move to the upside and get above that 153.67 or so level, that should be more positive for the pound as well.
Yeah, that's a great chart, Greg. That some big levels just right up ahead. So
yeah, it's this is part of kind of being aware and being prepared and anticipating what may happen or what may not happen. So you got to be ready. That's kind of my key for the employment as far as trading it is make sure that you know your levels, and if you know your levels and it breaks above that level, now you have something to define your risk against.
Yeah, and another one I'm going to mention is the euro as well, because that's one that's very difficult to trade right now around a U.S. event, because 5 minutes before or after non-farm payrolls, we can get a headline out of Greece. We have German industrial production overnight. And the euro has been very volatile on its own just over the last few days. So I mean, that's one I generally like to stay away from if I'm trading through it, or if I'm trading right now. Dollar yen, on the other hand, it's been a little bit of a dull trade, but it is a bit more straightforward in terms of good news. It's going to drive that trade a bit higher, and we don't need to bring up the chart unless you want to, but it's really just stuck in the range. But it will break that, and my guess is if we have a very strong employment, it will break and be sustained. But I really don't see the rush to get into that until that actually happens.
Well, I'm not going to not put up a chart, Adam. You know that, but we've been looking at this hourly chart here on the dollar versus yen, and it's a bunch of make sure I get it up here again. It's a bunch of up and down activity here, and some of the key levels for me is to get and stay above the 200-hour moving average. That's this green line right here. I'm sorry, you see it?
There we go.
Okay, there we go. Okay, you see it?
I see me.
Okay. Well, you should be live now. We should be on.
All right.
There we go. All right, get above the 200-hour moving average of 38.2% retracement. And then this trend line up here is of significance to myself as well. Around the time that the employment number comes out, it'll probably be around the 118.08 level. We have the whole high that we saw on yesterday's trading coming around the 118 level. Let's just call it. So really the 118 to 118.08, get above that level, and I think we're okay. Or that opens a door for further potential upside for this pair. We've had a lot of failures in the dollar versus yen over the last half a month or so. Fail breaks to the upside, fail breaks to the downside. So you got to be aware of those fail breaks and tread lightly. On the downside, if we do get a weaker number for the dollar versus yen, breaking through the 61.8% retracement level here, it held for the most part here. We had that fail break here. That was a bit of a problem. Again, below that level is how I'd see that pair.
Last one I want to mention is just stocks. It ties in with dollar yen a lot, but if we're coming to, there's a bit of a double triple top here in the S&P 500 after we had a false break to the downside, and a lot of times you see money come into the stock market after non-farm payrolls, whether it's good or bad, and it's just one of those events that keeps money on the sideline that comes in afterwards, and if you see that starting to happen, maybe that's the final sign for dollar yen, or maybe it's just a straight up stock trade. Because it can be good at some of the levels, even though it's been volatile.
Yeah, I guess it's no surprise that the stock market's had its share of ups and downs, and so has the dollar versus yen. So I mean, that old, if the stock market goes up, so too does move the dollar yen, and vice versa. I'll take a quick look at the euro versus U.S. dollar just to give some levels here that I'm paying attention to, as Adam said, you can have, we have all sorts of news coming out of Greece. The number of headlines that are coming out are just incredible, it seems.
Tough to follow.
I don't know when these people sleep. But getting above the 115.39 level, we talked about that level in yesterday's report. When we had that squeeze a couple days ago. So that's step number one. The other level is a 116.39 level, and again, that level corresponds going back to November of 2005. That was this low right here, 1639. So that was a 2005 low. Okay, so I consider that a key level on the top side. That if the market should approach that level, don't be surprised to see sellers in that vicinity. And then 117.43. That was, these are just levels on the top side. I'll talk about the downside. Doesn't necessarily mean I think it's going that way, but if we start to get this, continued squeeze to the upside, 117.43, that was the level, the accounting level that the euro was introduced on January 1st, 1999. So I consider that a key level, and as you can see, when we went down and tested that on our way to the downside, we've pretty much found support against that level, found support, found support, found support on a little bit below, and then broke and then used that level as resistance. So I do think the market pays attention to that. Those are kind of my three big levels on the top side. Not that we're going to be going there tomorrow, but if the momentum continues in that directional bias, those are levels that I would look to sell, and I think the market would look to sell against those levels. On the downside, nice little trend line here with the 200-hour moving average. That's going to be of interest. Even in today's trading, we found support against 100-hour moving average, just blue line in the chart, and the market bounced off of that. So it's always 100 and 200. That always comes into play. But I like the fact that the 200-hour moving average in this trend line is kind of tracking. It might be moving. It might move a little bit higher by the time comes tomorrow. That moving average away from that line. But those are getting below those levels and staying below those levels will be something that I'll be looking for on the downside for the euro versus U.S. dollar.
Last one I want to touch on is just the Canadian dollar. Don't forget it's
also
employment report tomorrow. I think you said about 5K expected. I mean, the Canadian press, just reading the last couple of days, is very bearish, starting to sound on housing, and that can be a self-fulfilling prophecy. So they're talking about panic in the housing market. Houses that were for sale in November at 1.4 million, selling for 900,000, or listed for 900,000, and not selling. And also household debt, very high ratios in Canada. So there's some bearishness sinking in the, I think, the public mind, and a negative employment report, even though it probably doesn't mean that much in the grand scheme of things, would be a scary sign. But on the upside, it was very quiet a couple of weeks ago. Statistics Canada re-released all of last year's employment numbers, and they took off about a quarter of all the jobs. So maybe there is some give back. That's sort of the feeling. Well, those jobs have to come back somewhere, or it is strange to see a revision of that magnitude for an entire year. So that might keep the market a little bit off keel. But dollar CAD, I believe it's a strong buy. I mean, oil is locked to dollar CAD, or vice versa at the moment. So that's a huge risk with oil moving 6% again today. So keep that in mind. Whatever happens on the employment report, oil will be a bigger factor, but Canadian dollar is in a tough spot. I just can't see it hanging on to doing the gains it made today.
Right. Yeah. We're maybe tomorrow with the employment number, the market will sort of take their eye off of the oil trade for a day and focus on those fundamentals that you're talking about, the housing weakness, and just the overall weakness within the starting to build over there in the economy, and get the Canadian dollar weak again. We do see oil prices move higher here today, and a little bit technical selling as well here against old trend line, and the 100-hour moving average tested it once, twice, three. Just couldn't get through there last night, Adam, and then things started to unwind here, holding that 200-hour moving average in the process and moving down to, again, our low levels. We talked about these levels yesterday around this area right here. Went below it, went to your 61.8% retracement just 2 days ago, and then found support against this 123.93 level, which goes back to this high right here at 12.93. Or 123.93. So we're finding some support where we found support just in yesterday's trading. That's a shock. People can see that, and they just define their risk and limit their risk against that level. So they're expecting, what, 5,000 jobs, an addition of 5,000 jobs. It comes after an 11 or so thousand decline last month, and so keep an eye on that. And maybe an opportunity there for you traders who want to just catch a trend in the dollar versus Canada. Great.
All right, Greg. Thanks a lot. I mean, it should be fun tomorrow. 8:30 a.m. Eastern. That's 13:30 GMT. Biggest employment report of the month, or the biggest economic data point every month. So it should be fun.
Yep. All right. Thank you very much, Adam, and thank you all listeners out there. Good fortune with your trading. Make sure that you define your risk and limit your risk in everything that you do, and pay attention to the details. I think that's where we're going to see the opportunities in tomorrow's trade. Bye-bye now. Good luck.